tax break. And then that same tax band now is there in the fall, and you can either pay tax on your harvest or get it tax-free. Well, society tells you to get your seed money tax-free and pay money on your harvest. That's the qualified plan.
Sure.
So you're contributing a small amount of money, hoping it blossoms to this lovely retirement account, and now they're there with a big smile on their face, and they're saying, okay, you now owe me this much money. So it's really the qualified plans are not always the best alternative. And if a client says to me, Dave, I need $72,000 to live on, not the net $47,000 after taxes. So okay, to realize $72,000 of income, I have to now take out $115,000. I'm out of money in 13 years. I got 7 years of life left.
There's other strategies that people could be doing.
There are.
And I've been to Doug Andrews' course. I got certified in his program, and I had an epiphany, and I saw the light as to how I'm currently advising people. And they have to be open-minded, because these are strategies that I myself 5 years ago weren't implementing and sharing with the consumer. And when you look at it on paper and you look at the big picture and you look at doing planning, which is exactly what financial planning is all about and meant to be, which is giving you a blueprint, an opportunity to run some numbers and look at the consequences of doing this or doing this strategy, it really does make sense for people to try on this new strategy, this new perspective. Go ahead.
I want to take that blueprint for a second. Because when you read all the magazines, all the TV shows, all the, we're paying attention to you, and you listen to the financial advisor industry, financial planning industry, it's all the same thing. Diversify your portfolio, put it into mutual funds, be well weighted, but is it really customized to the individual? It's customized to the financial industry because they're going to make money on this. They're not really paying attention to how does the individual benefit from this program.
Yeah. Tailored. Products today can be bought through the internet, can be bought, all over the place, and they become a commodity, as you had alluded to earlier. And very often, a human being adds a certain touch, allows you to ask the questions, allow you to explain and educate you as to the areas that you may not be familiar with. And I've gotten tremendous value out of some of these concepts and some of these thoughts. And the consumers that are working with me are just so happy, because what they realize in their planning is they're putting more money in their pocket and they're paying less in income taxes. And if you're paying attention to communications from the media, you're hearing how difficult it is going to be to retire and accumulate enough wealth. One of the distinctions I want to just bring to your attention and discuss with David is the concept of a present value interest versus a monthly payment. And this is something I picked up, and I just think it's absolutely brilliant. So let's just use an example of tapping $100,000 from the house, and at 6% interest, that'll be $6,000 a year as a payment. It is deductible, and I'm going to pay $500 for that money. So strategy one is tap the $100,000. I now have $100,000 in my pocket. It's a present value. I'm not going to discuss what to do with it yet, but I promise I'll get there. But I got $100,000 in my pocket. It's a present value interest. Versus the normal way we used to do things, if not currently do things, which is paying $500 a month and $500 a month to accumulate wealth. Now, if you notice, both examples are costing me $500 a month. But after 3 months, in this pocket, without interest, I got $100,000. In this pocket, by adding $500 to an account, I've accumulated $1,500. Ladies and gentlemen, which pocket would you rather have? Can you expand?
Well, what it does is we discuss the 4 phases of lump sum retirement planning. Because what happens is they say, well, over history, Wall Street has returned X number percent. It varies between 8 and 10 depending on who you listen to, their methodology. But what happens is consumers don't realize their account might be growing. Let's rewind back to 2000. Everyone was having a grand time. Wall Street returns were 30% on average. It was ridiculous money. It was like having a party. No one paid attention. The wolf was in the hen house and no one cared. So what happened was now all of a sudden they got whacked. Their investment values dropped by 50%. What if I had to retire in that year?
Right.
I can't retire now. So we talk to clients about when you lump sum retirement plan, let's put the money somewhere. Let's take the monthly discretion out. We know the money is over here somewhere. But the key is to making sure it goes into a guaranteed environment.
It's got to be prudent,
It's got to be prudent. We don't want it to go into the stock market, into an IPO, into someone, there's a lot of crazy investments. I alluded to the last point, the tortoise wins the race. If we can go find you a guaranteed environment, earning you 6%, 4%, some of them are earning in the double digits,
sure,
depending on the tailor-made plan.
Right.
They exist out there, and you can work your money accordingly. And by controlling and repositioning money, we cover all 4 phases of financial planning.
Number one.
Number one is during the contribution phase. Is it tax deductible? Indirectly, this might be. We have home deductibility on your interest is deductible.
Number two.
Number two is how does it grow? These grow tax-free, not deferred. Some of these grow tax-free if structured properly.
Number three.
Number three is how am I getting my money?
Distribution.
I want to take my money and retire. We alluded to an example a couple minutes ago on a qualified plan is fully taxable. Some of these products, when they're structured properly, money comes out tax-free.
Let's mention one.
Mention one. If you can go to some of the planners we use around the country, we'll use what's called a investment-grade insurance contract.
I use it.
People hear the word insurance, they run for the hills. Everyone loves to get insurance proceeds, but no one likes to pay for them. But the insurance industry designed these products really for investment vehicles. The government says you have to put insurance with them.
If structured properly.
If structured properly.
Correct.
And we use them, there's no limitations on how much cash can go in, how much you can grow, who can contribute. You can set them up as college planning, retirement planning, and have them do a lot of various things that are out there. And the insurance just happens to be along for the ride. And so the insurance industry has kind of a bad name because you can hurt people.
I'd like to discuss a couple of the characteristics or features